Hi, I'm Rick Kaler. Thanks for joining me. Well, need a new car? Simple. Buy used. That's what I always do. My sweet spot is a low mileage vehicle, 2 or 3 years old, and I have found that I can usually find that vehicle for 25 to 35% less than the original cost. Now, I call that a deal. And I just bought a used car with 16,000 miles on it that was 2 years old. So I routinely recommend this strategy to my clients, staff, friends, and anybody else who will listen. If everybody followed this advice, you'd think this strategy would eventually fail dismally. I mean, after all, someone has to buy the new cars. But no worries. There are millions of people who will continue to buy new cars. Financial planners have recommended this strategy for decades, and nothing has changed in the supply of great deals on low mileage cars. The same applies to investors who invest passively in index mutual funds. Passive investors embrace a philosophy that extremely few investors can beat the average return of the stock market. Research by Dalbar Incorporated shows that over a 20-year period, 97% of fund managers who tried to beat the market actually ended up worse than the market average, 97%. They suggest that instead of paying a manager to try and beat the market, you pocket that money yourself and beat them by investing in low-cost index mutual funds that simply earn average return for the market. Well, as you might guess, those pushing the high-fee active mutual funds, whose job is to try and beat the market returns, are typically the big Wall Street firms that need your money to keep their companies thriving. Not surprisingly, these firms regularly attempt to dissuade investors from passive investing. An article at ETF.com by Larry Swedroe, the Director of Research for the BAM Alliance, lists a few of these attempts. Representatives for two large brokerage firms call passive investing worse than Marxism. Wow. And if you do that, they call you parasites. Another, however, gives a more reasoned warning that is worth exploring. Tim O'Neill, global co-head of Goldman Sachs' investment management division, says, if passive investing gets too big, the market won't function. That's similar to saying if everybody's buying used cars, there aren't going to be any new cars for anybody to buy. So up to a point, this idea has some validity. Swedroe says active managers play an important societal role. Specifically, their actions determine security prices, which in turn determines how capital is allocated. And it is the competition for information that keeps markets highly efficient, both in terms of information and capital allocation. So, passive investors get a free ride at the expense of active investors. As Swedroe notes, they receive all the benefits from the role that active managers play without having to pay their costs. That's kind of like having your cake and eating it too. Passive investors need active investors to continue to believe they can beat the markets, just like a used car buyer needs new car buyers to supply them with used cars. Now, just how likely is it that all the people who invest with active investors will figure out that paying active managers is not in their best interest and will shift to passive investing? Well, I'm going to guess it's about the same chance everybody's going to stop buying new cars. Consider this. A study by Vanguard, one of the largest passive fund managers on the planet, found that 10 trillion or 20% of the global market equity is invested in index funds. That means 80% is active. More importantly, this 20% accounted for only 5% of all the trading. And it's the trading that drives market prices and makes markets efficient and liquid. Swedroe notes that we are nowhere near the chance that passive investing will become so dominant that the efficiency of the markets would be threatened. Just as there's no immediate threat of the used car supply drying up because no one's buying new cars, there's also little chance that the majority of investors will give up the delusional dream of beating the market. That means wise used car buyers and wise passive investors can keep on following their wise wealth building strategies. Thanks for listening.